Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? I hope you're having a great day out there. Today we're talking about 4 ways to avoid paying tax on Social Security when you decide to take your Social Security. Look, when the new Trump tax law came out, it just got harder to avoid paying taxes. It's like a game, right? You try to get ahead of the game and then they change the game and you're, oh, darn. But it got harder, especially for Social Security. At the end of the day, you kind of just work through it, see what fits for you. It's hard to do a general video for this one, but I'm going to go through 4 different ways that you can maybe strategize a little bit and give you some details into this. And if it gets confusing or anything, ask your financial advisor if you don't have one or he won't work with you. I hope you'll consider us here at Jazz Wealth, but this will be kind of a general one to get you through it, or at least get you thinking about it, right? That's the goal here. Okay, so Social Security says whether you owe tax or not on your Social Security distributions when you do finally take it, has to do with something called your combined income. So according to Social Security, your combined income, they don't mean you and your spouse on this one, right? What they mean is the total of your adjusted gross income, whether you're married, filing, whatever it is, your adjusted gross income in there, your non-taxable interest, right? And then 1/2 of your Social Security, whatever that may be. That's your combined income. So what's really happening here is when they make that decision whether you owe tax or not, they're adding up all of that stuff there. So depending on your filing status, depending on how much you make, distributions, things like that, whatever you take from there, you could owe 50% of your Social Security benefits could be taxed, or up to 85% of your Social Security benefits could be taxed. So we want to play a little strategy here. Everything legal, right? We just want to pay the least amount of tax possible. At the end of the day, getting into retirement is important. So let's go through 4 different scenarios here. Number 1, you could just simply take your Social Security when you're done working, right? And it's tough because everybody's a little bit different here, but what you could do is say, well, when I'm officially done working, I'm going to start taking distributions from my IRAs, my 401ks, whatever it may be. I need income still. And then I've got my Social Security as well. So when you add up your distributions and 1/2 of your Social Security, you could rather quickly see whether you're going to owe tax on Social Security or not, and then make that decision. When am I going to be done working? If I'm sort of cutting it close, right? If I wanted to retire at 68, but I might have to wait till 69 or something, just do the math real quick and check it out. If you have a well-paying job, of course, you're not going to quit. You enjoy it. If everything's going well and you're making money or you need the health care or something, then of course you'll probably stick it out. But if you have, like, a lot of people end up getting these part-time jobs just to have like extra income, something to do or whatever, and they're really close to retirement. I can actually think of one scenario where we worked it out with a lady. The lady was working at an ALF, just kind of part-time. She was enjoying it, helping out the elderly. And she wanted to start winding it down. It was taxing on her body. And so we actually worked out and we were able to figure out that, hey, even with the RMDs, when you retire and everything, technically you could retire now and you'd make a couple more dollars getting Social Security because it wouldn't be taxed than if you just start taking Social Security and wind down your job. So number 1 is just simply take Social Security when you're officially done working, whether you have a goal in mind or you just physically have to stop working. Number 2 is a little more detailed. You could take from your Roth IRA first, or your post-tax money, your Roth 401k, etc. Now this is not for everybody here. I'm a big proponent, and most of the time I can actually show you where taking from the Roth last is the best bet. But hey, it's an option. You could take from your Roth first. Why is that? Because if you take from your Roth IRA, it's not taxable income. So we won't have any AGI, right? If we're only getting our income from our Roth. That makes it a lot more likely that you're not going to owe tax, or even if you do owe tax, maybe you'll be in that 50% bracket there. So that could be the case. Now, when you turn 72, because now 72 is the new RMD required, or year that you're required to take RMDs, you could go to your pre-tax accounts, take the RMDs, then go right back to the Roth. Right? And now this is going to be for the people that have a substantial Roth IRA, Roth 401k, Roth TSP, or you've done some conversions over time. Our video on Friday is actually going to show you some conversion ideas there. But it's not for everybody. You're going to want to talk to your accountant or your financial advisor on that one. But number 2 is you could focus on the Roth. If you did want to retire, your Social Security likely wouldn't be taxed. you kind of might be signing up for getting taxed in the future. So we'll want to consider some conversions over the long haul there to get more detail. Okay, number 3, here's something you probably didn't know. If you don't need the money, you could actually gift the RMDs to charity. So let's say that you go to retire, everything is cool, you're doing your thing, but now you have to start taking the RMDs, and because you're taking the RMDs, you have income, right? Or it boosts your income, and then now you might owe some tax on Social Security. Well, you can actually gift up to $100,000 of RMDs a year to a charity. It's called a qualified charitable contribution, which just means the money goes to a charity, it never touches you, and because it never touches you, it is not taxable, so it means that we're back to this game here, right? All of a sudden, you've got 1/2 of your Social Security, maybe a little distribution here and there, but you're keeping yourself under the limits there. So that could be something for you there. Quick warning, you can't do this from a 401k, right? So we have to take an extra step. So you could do qualified charitable contributions from a traditional IRA. You can't do it from a 401k directly. So that means you're going to have to do a rollover first, then give it away if that's the plan. Plus, it makes you feel good, right? You get to help out a charity. And number 4, we're on to number 4 now, skip tax-free municipal bonds. Remember, I left this up here for a reason. Non-taxable interest. What in the world is non-taxable interest? That could be your tax-free municipal bonds. They are an attractive vehicle for retirees. That's great. But unless you have a substantial amount in there and generating so much income that Social Security is like dust in the wind and you're just like, whatever I get is fine, then you may want to consider avoiding tax-free municipal bonds. It's tough. They get marketed to you a lot. That's really popular down here for the retirees. They get marketed those incredibly a lot. So anyways, you may want to consider skipping the tax-free municipal bonds because they raise your combined income. Now you've got distributions from your IRAs, whatever they may be, maybe a little income. You got non-taxable income, non-taxable interest from your municipal bonds. Oh no, you've got 1/2 of your Social Security. Chances are you're going to owe some tax on your Social Security. And we're trying to avoid that. That's the topic of the video today. So tip number 1, take Social Security when you're done working or just delay it as long as possible. Tip number 2 is to consider using your Roth more in the beginning and then working on conversions for your pre-tax dollars. Tip number 3 is to gift your RMDs to charity if you can and qualify, and it's a qualified charity. It's got to be a qualified charity. And tip number 4 is to just skip the tax-free municipal bonds, man. Unless you have a lot of money in those, maybe you want to skip those. Anyways, I hope you found that helpful today. If so, check us out, jazzwealth.com. We help investors of all sizes, but as you can imagine, we're here in Florida, so we do have our fair share of retirees and pre-retirees as well. If this is getting a little complicated and you want someone to kind of work through it with you, I hope you'll consider working with us. Worst case, hit the subscribe button, thumbs up button, all that good stuff. I just appreciate that you're watching. Enjoy the rest of your day. We'll talk to you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.